Welcome once again. Today we're going to look at IS1, which is presentation of financial statements. Now in this video you're going to get a detailed explanation of what IS1 is all about. Now before we dive in, let's take our objective and scope. Objective to set up the overall requirements for the presentation of financial statement, guidelines and their structure, and minimum requirements from their content. Scope applies to all general purpose financial statements prepared and presented in accordance with International Financial Reporting Standard IFRS. Now, before we dive into the components of financial statement. Now, what IS1? Let me to give an abridged explanation of IS1. What IS1 is saying is just to tell us how financial statements should be presented. IS1 is not telling us to compute anything. IS1 is not saying that we should add this. No. IS1 is just out there to give us a guideline, a format on how financial statement should look like. That is to say, when I prepare my own financial statement, it should be the same thing with when you prepare your own. It should be the same thing when somebody in US prepare their own. It should be the same thing when somebody in Ghana prepare their own. The only difference is the content, but the presentation, the format, everything will be what? The same. That is how it should be presented so that there will be no confusion, no mix up, and all that. That is what IS1 is all about. Just a way, a standard format in which financial statement should be presented so that when I open it, I know what I'm looking for. Is the same thing like when I open another. Is the same thing when I open another. Is the IS1 is not talking about anything computation, calculation, or anything. It's just giving us a key, a format, a template on how financial statement should look like. Now, let's go into the components of financial statement. Now, statement of financial position, that is our balance sheet. Say that show us the assets, show the assets, liability, and equity at a specific date. Now, this component, the financial statement, the financial position is one of the components of financial statements. Now we're explaining the component of financial statement. He said that show the asset, liability, and equity at a specific date. That is when you come to financial position. This is what you do. You show the assets of the company, the liability, the equity at a what? A specific date. There should be a date in which you show these assets and liability, equity of a company. Now the next one is component of comprehensive income. Can be presented as a single statement or two separate statements, income statement and statement of other comprehensive income. Now, this is another one. Statement of comprehensive income. It's also a component of financial statement. And they're telling us here now that it can be presented as a single statement. Now, mind you, the financial position should be on a page. Statement of comprehensive income on another page as a single word statement. Are you getting it? Let's go to the next one. Statement of change in equity shows changes in equity during the reporting period. Now, another one is statement of change in equity. You see, this one shows what the changes that occur in the company, in the equity during a reporting period. It could be for a year, It could be for 6 months. It depends on how the company is keeping the account. It depends on the year they have chosen in which they can prepare their financial statement, which is their end of the year account. But here is telling us that show changes in equity during the reporting period. White, good. Now, statement of cash flow. That is another one. Shows what? Shows cash inflow and outflow during the period, during the year, during the accounting year. That is the work of statement of cash flow. Shows what? Cash inflow and outflow during the what? Period or the accounting year. Now the next one is note to the financial statement. Note to the financial statement. Provide additional information about item in the financial statement. Now, let me throw more light on this note to the financial statement. When you have your revenue, you have to list the cost of sales. Now, the cost of sales, they want to know how you arrive at the cost of sales in your income statement. There will be a note there, maybe note one or note two. Then the person will need to go to your note to the account to see the computation you have made. Opening stock, add purchases, less closing stock, and you arrive at your what? Cost of goods sold, your cost of sales. They want to see how you arrive at that. Then you just pick the figures to the income statement as your cost of sales to be dash dash dash, because they went back to note 2 and they saw how you computed to get your dash dash dash. So the note to the account explain everything, all the figures in your account. Anybody that is confused about how you get a particular figure in your income statement, in, in your financial position, we will do what? We refer back to your note to the account, note to financial statement, and go there and check and see, okay, how did you get this? How did you get this? Okay, okay, this is what they did. Yes, yes, it's in line. Good and fine, fantastic. And the person will progress. So, these components of financial statement are the five reports that you have to include in your financial statement. And they have showed you what and what each is each can be what can be contained in each of them, like the statement of financial position, statement of comprehensive income, statement of change in equity, statement of cash flow, and notes to the financial statement. I'm just explaining this. I'm going to show you a template of it, of IAS 1. This is IAS 1. So you have to know all this so that anywhere you see IAS 1 financial statement, you know what to look out for. White, good. So let's go to general feature. Now, general features is one, fair presentation and compliance with IFRS. Financial statements must present a true and fair view and comply with IFRS. Yes. The financial statement, you don't just go and prepare financial statement because you know how to prepare financial statement. It must what? Comply with the what? Standard, with IFRS standard. And it must show a true and fair view of the finance, of the position, of the strength of the company. And also it must be in line with international financial reporting standard. If you go out of fit, that means you are not obeying what IS1 is saying about. It must be in line and in compliance with international financial reporting standards. So one of the feature is what? Fair presentation and compliance with international financial reporting standards. Second one is going concern. Financial statements should be prepared on a going concern basis unless management intend to liquidate the word entity. As you're preparing it, it should be in your mind that this business is a going concern. We continue to operate. We continue to operate except the management say, okay, uh, I think this is our last financial statement. We have to prepare a statement to sell our assets and pay the people we are owing and sell our asset, get money and liquidate our liability so that we can go off business. If the management did not make this pronouncement, you prepare your financial statement as a what a going concern. When um, a company is about to liquidate, they prepare what is called a breach financial statement. Yes, I'll come to that later. A breach financial statement, in which they are just what they do is to sell their assets and settle their liabilities and go and sleep. Everybody go to their house. But IS1 is saying as long as the business is existing, prepare it as what a going concern one. Now, the next one is accrual basis of accounting. Items should be recognized when they occur, not when cash is received or paid. That is one of the things you will maintain in what IS1 is saying here, that you must follow accurate basis of accounting in preparing your financial statement. It items should be recognized when they occur, not when cash is received. Like if you have basis of account, you have the accrual and the cash basis. Cash basis is when they receive cash. That is when they recognize it. When they pay, that is when they not when it occur. In cash basis, in in cash basis, you might say, okay, I want to buy this thing. They they don't recognize it until cash, until they collect money. But in Accra, you can actually buy. Then we'll recognize it as we've made sales immediately. But the money has not come. So the person becomes what? Our debtor. Person will be owing us. But in cash basis, they don't record. They say, okay, he picks some things, okay. Till he brings the money, then we'll record as our sales. So what IS1 is saying that items should be recognized when they occur, not when cash is received. It's mostly in government parastatals that they use cash basis. But private entities in the corporate world, we use what? Aqua basis of accounting. So hope say they enter good and fine. Let's go to materiality and aggregation. Here, material items should be presented separately. When they say material item, items that are what? Material. We have items that are what? Immaterial. Like when we went for an audit, a colleague of mine, he came up with a voucher and said that this money that he cannot find it, I asked him how much is the money. He mentioned a small like a small amount of money compared to what the business is generating. I said, wow, this money is immaterial. Okay, it's immaterial. It's not something we should dig deep into. It's what? Immaterial. Okay, like let's take a look at um one of the big company. Now let's take a look at um let's come down one of the oil company. Let me not be specific. Let's say one of the big oil company in the world, and eventually you are looking for 1 million. Let's say a company that is dealing with dollars. Let's say now, okay. Let's say now they have their revenue is about 250 billion US dollars. Then you are looking for $1 million. Well, 1 million is immaterial to what they are generating. So what is immaterial to you might be an expenses to the other company. Some company recognize stapler as what? As an asset. Why some company recognize some cars that might not be above 1 million as expenses. So it is the policy of what? Of the company. That is when we come to IIS 8, accounting policy estimate and error. So I think I did a video on that. We'll come. Oh yes, I did a video on that. You can check it out. So it must material items should be what? Presented separately. Separately. That is why they say, this thing is immaterial. It's immaterial. That means the thing has no carry weight. No carry weight. It's not something you should dig deep about. But when it is material, it becomes a point of attraction. It should be reported separately in the financial statement. Offsetting asset and liability or income and expenses should not be offset unless required or permitted by another standard. This is also talking about IAS 8, accounting policy estimate and when estimate is when the management make what? Judgment on some items. Whereas the policies is when an accounting standard, a new accounting standard is adopted and you have to abide by that new standard. That is the policy. Now here is saying asset and liability or income and expenses should not be offset unless required or permitted by another standard. You don't offset your assets. You don't hit your asset off or hit your liability off because you want to hit it off. You don't say, no, no, this one, no, no, I don't want it in my financial statement. Hit it off. This one, I don't want it again. Hit it off. You only do that when there is another standard that supersedes that standard. I don't know if you're getting me. There must be another standard that that will come to supersede that. Okay, you can offset this. There is this standard backs you up to offset this. This standard backs you up to offset it. But if there is no standard like that, everything remain the same. Hope we are moving together now. Frequency of reporting. Financial statements should be what presented at least annually. Financial statement of a company should be presented at least annually and should be consistent every year as long as it's a going concern. Every year there must be financial statement. Every year. That is what frequency of reporting. So when you pick an account of 2021, you should be sure that you see account of 2022. You should be sure that you see account of 2023, 2024, because that is what IS1 is saying. Yearly. You don't see a merge account of 2021 and 2022 together. No. IS1 is not saying that. You see, at least financial statements should be presented at least annually. Annually. The next one is comparative information. Comparative information for prior period should be what disclosed. For example, we are handling for 2022. 2021 figure should be there for comparison. Maybe your revenue for 2021 is 2 million, then revenue for 2023 is 4 million. There should be a comparative information, comparative figures for both. You get. So that is what this one is saying. Now, structure or content. I'm just digging deep about all you need to know about IS1. Now, identification of the financial statement include the name of the reporting entity, whether the statements are for individual, entity, or a group, the reporting date, and the currency. Now, when you check a financial statement, the first thing you see is the reporting entity, the name of the company that is reporting that financial statement. The next thing you see again is what? The statement, the element, sorry, the components of the financial statement. Is it an income statement? Is it a financial position? Is it change in equity? You must state it. Then the year, the reporting year, and the currency that is in use, very, very key. And the figures, very key. Now, this is the content. When you pick up a financial statement, you should be able to know the company. You should be able to know the year they are reporting it. You should be able to know if this is an income statement, a balance sheet, sorry, a financial position, or change in equity or cash flow. It should be written there. Then the currency at which they are reporting that should also be there. Right? Good. Now, presentation of the of statement of financial position. Separate current and non-current assets and liability. Separate it. Current and non-current assets should be separated. You have your non-current assets, your PPE, then you have your current asset, your cash at bank, then you have your liability, your payable, long-term and short-term, should be what? Separate. Now, presentation of the statement of comprehensive income can be presented in one continuous statement or two separate statements. It can be presented in one or two. I will show you a format that fits in with this. Okay, that is what we are saying. And all these things, all must be what? On a separate sheet. On a separate sheet. I will explain detail while showing you the format. Change in equity shows total comprehensive income for the period, transaction with owners, and a reconciliation of the carrying amount at the beginning and end of the period. Now, change in equity. You have your share, then the profit you made for the year, then you add it up or you less. If you add or less, it depends on your profit. If you made loss, you less. If you made profit, you add it up. It will now have your what? Your equity and your return earning. So that's what this place is saying. Show total comprehensive income for the period. At the end of the year, you check if the equity of the company is increasing or reducing so that investors can know what to do. Now, let's example breakdown. Let's consider a simpler example of a company financial statement following IS1 requirements. Let's go. Good. Fine. Statement of financial position, which is formally your balance sheet. Now, like what is this? Is the reporting entity, Mr. Israel Nigeria PLC. Oh, yes, Mr. Israel Nigeria PLC. Statement of financial position. Now, components of financial statement. Remember, components of financial statement. This one now is statement of financial what? Position. That is what we are talking about here. The year as at 31st December 2023. So this here is key to IS1. Now you know the company that is reporting this, you know the component of financial statement in which they are reporting, and now as at the date, you know the period. The the currency should be here. If it is dollar, naira, pounds, the symbol should be here. Sorry, I didn't put it. The symbol should be here. That is one of the requirements of financial of IS1. Now, if you leave it like this and you are reporting these figures, what is the returning currency you are reporting? Is it dollar? Is it pounds? Is it naira? No, because it was not stated here. But IS1 is telling us what? State the returning currency here so that we will know what we are seeing, the figures we are actually seeing. Now, this is the assets. This is the assets, cash and cash equivalent, accounts receivable, inventory, inventory. Now, this is non-current asset. Let me bring it. This is non-current asset. Now, remember initially they say we should separate what? Non-current asset from current asset. That is what IS1 said in the balance sheet, in the financial position. Separate non-current asset from current assets. And this is the separation here. Current asset have your cash and cash equivalent, accounts receivable, inventory. The non-current asset have your PPE, property, plant and equipment, intangible assets, give a total of non-current assets. Now, when you add this and this, it's going to give you your total assets. So this is the total assets of the company. Now, anybody that wants to invest will just come here and say, okay, what is the total assets of this company that I want to go into? Now, the total asset, current liability, current asset, non-current asset, 350. Okay, okay, okay. Now, the person will say, let me check out their liability. Who and who are they owing? What is the weight of their liability? Remember, IS1 said we should separate all this. That is what is happening here. Liability and equity. He will come here and say, accounts payable, okay, short term, total current liability, 30,000. Okay, okay, okay. Let me see their non-current liability, long term, 100,000. Total liability is 130. Okay. The person has a view of the liability of the company because all these things are separated according to IS1 presentation. Now, IS1 is not telling you to come and prove how you get this figure. No. IS1 is just showing you how it should look like. Then there's supposed to be a note here, note here, note here, that if you are confused about, okay, you want to get the account payable, who and who are they owing? At times, you might not see it in the financial statement, but at times you don't see the people they are owing. You just have a picture of how much they are owing people. Then, if you want to get a detail of how you can meet them, they will disclose the okay. Just imagine uh, a company that about 500 people. The company is owing about 500 people. If they include it in the financial statement go full now. So they have their records, and that is one of the work of an auditor to vet those records and authenticate the figure here. Right? So that is why you should rely on this because an auditor, a reliable auditor, is involved. Are you getting me? Good. So total equity, this is the share capital now. It's 150. Okay, return earning, they made this. Total equity is 220. Now, total liability and equity should give you 350, which is the same thing as their total assets. It must be the same thing. Their assets, their liability and equity must be the same thing with your total assets. That is when you know the account is what balance. Now, we talked about comparative figures. Now, this template is for a new company that is just starting who don't have a comparative figure for 2023. Now, if you want to prepare 2024 accounts now, all these 2023 figure will line up here to compare this because this is the current figures. Now, cash account equivalent for 2023 is 50. Maybe in 2024, cash account equivalent might be 100,000. You compare. So you always have your comparative figures here and your current figures here. So that is that. Let's go to the next. So this is the template how financial position look like according to IAS 1. This is how it would look like. Now let's go to, you see some similarities. Let's go to second one. This is our statement of comprehensive what income. Now check, the name of the company is still there. Now it is no longer financial position, component of financial statement. It is no longer financial position, but what? Statement of comprehensive income for the year ended 31st December 2023. You see, now our returning currency is what? Must be here. I did not put it so that I will always emphasize on it. You can put dollar if it is in dollar. You can put naira if it is in naira. Whatever returning currency it is, you put it here. Now, I made mention of returning comparative figures. Now, the comparative figure should be here, and the current figure is here. I said this one is for a new company that just started that has no comparative figures. Now, statement of comprehensive income. This is the format. You have your revenue, cost of sale. Here you see some notes here. Other income, operating expenses, profit before tax, income tax. When you will see some income statement, you might be seeing some items that are not here. It's fine. It's fine. Some items that are not here. It's fine. Okay. This is just for a tutorial sake. Yes. But this explains what it is. Right? Good. So this is how your statement of comprehensive income will look like according to IAS 1. Right? Or here you see, here now you see note 1, note 2, note 3, 4, 5, stuff like that. Now, when they said that your financial statement of comprehensive income can be prepared in one single page or two, is here. Other comprehensive income can be prepared in another page or can be merged together with this. That is what they are saying. So if you see a financial statement where other comprehensive income is in another page, it is fine. It's still following the standard of what? IS1, presentation of financial statement. Then if you see it the same on a in the same page, it is still fine, right? So this is all revenue has its own standard, like that, like that, like that. But this is IS1 presentation. They just want to know how you don't. They just want to show you how you present your financial statement. Is that right? Fine. Let's go to the next one. Statement of change in equity. Now, there is still similarity. The name of the company is there. The components of financial statement here is what? Changing statement of change in equity for the year ended, then returning figures will be here. Now, if you check some statement of change in equity, you see preference share, ordinary share. You still see revaluation, right? But here I just decided to use share capital return N. So it's fine if you see those things in other financial statements. But this is just for a tutorial purpose. And this is how it should look like. So in other one, you can see preference share, ordinary share. It's fine. It's fine. Just make sure that your statement of change in equity is presented in a single sheet. Excuse me. In a what? A single sheet. And should follow this format. Right? Because it depends the size of the company. A company that makes billions will have more uh, the return and the change in equity will be populated. A company who don't have other who doesn't make any significant sum will discount it. So It's like that. But the main thing is that this is how IS1 said we should prepare what? Financial statement. The presentation of financial statements. This is it. Now let's move. You get to with cash flow. The similarity, the name of the company, statement of cash flow, that is the component of financial statement, the reporting date, and don't forget the returning currency. Always put the returning currency. You have your cash flow, cash from operating, net cash from operating activities, cash from investing, cash from financing, and then you get your net cash in cash and cash equivalent. This is what IS1 is saying. Present your cash flow in this format. Present it in this format. Now, this also you might check other cash flow and find out there are some items here that are not there, and there are some items there that are not here. Yes, it depends on the strength of the company. Right? Some are populated, while some are less populated. It's fine. The important thing there is for you to follow the standard. And let me tell you one secret here in cash flow. Somebody prepared account and said that my account is balanced. What I check to see if your account is balanced is not your financial position. Your financial position can be balanced. You can doctor it and it will be balanced. What I check is the cash flow. You understand? I just go to the cash flow, and most people don't know that cash flow can also be used to check if your account is balanced, to check the authenticness of your account. You don't know, see what you will do. Your cash and cash equivalent as at the end of the year must be equal to your cash in your financial position, to your bank, cash or bank in your financial position. It must be equal. Now, this cash and cash equivalent of 50,000 will be the same thing here. Let's go to our financial position. Cash and cash must be the same thing. So this fellow, he brought the accounts out. I'm done with the preparation. I checked the balance sheet, it's balanced. Cash flow did not balance. I told him your account is not balanced. Go and balance your cash flow. The cash flow took him 2 days to balance. Before we look into it together, we'll find where the error is coming from. And we'll adjust it, adjust also the financial position. So that is that. So this is all about IS1. It's just presentation of financial statement, how financial statement should look like. When you handle it, the things you should see is how it should be arranged, how it should look like, so that when you handle it in Nigeria, it's the same thing in Ghana, it's the same thing in US, it's the same thing all over the world where they are maintaining accounting standard. International financial reporting, where it is being uh, obeyed and maintained, should be the same thing. So that is all about IS1. IS1 did not say add 1 plus 1, add 1 plus 1, add 2 plus 2, add this. No, 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 no. IS1 did not say that. It's just what the presentation of what financial statement. Please, if you have any question, don't fear to ask. Don't fear to ask. We are here together to help each other. So the comparative figure, the returning currency should be here, and the comparative figure also should be here, because this is a first year account. Preparing first year account is always difficult. Yes, yes, it's difficult. It's difficult compared to those have 1 year, 2 year that you just bring the comparative figures, then you kick off. Here you're building it from scratch. So that is so. Thank you very much. That's all you have to know about IS1, and I hope this video helps you. Thank you very much. See you in our next class. Thank you and stay tuned.